U.S. equities are ending March under heavy pressure. Geopolitical friction, higher oil prices, and a cautious Federal Reserve continue to bear down on the markets. The pressure is evident. The S&P 500 marked a 7.1% drop year to date, and the Nasdaq Composite fell 9.7%. But corporate data reveals a contradiction. First quarter S&P 500 earnings growth tracks near 13%, with 2026 growth projected at 17.1%. Stock prices are dropping aggressively, yet the companies inside those indexes are projected to generate more money than they did a year ago. This divergence suggests the market is undergoing a valuation-driven correction rather than a broad deterioration. In corporate performance, failing to distinguish between a profit collapse and a valuation reset leads to mispriced risk. Understanding this difference prevents panic during a standard market realignment. Three specific macro headwinds are driving this market fear: geopolitical instability, high oil prices, and a Federal Reserve maintaining a restrictive policy stance. These forces translate directly into the bond market, where they have pushed Treasury yields to elevated levels. We can see the impact of these yields through the fundamental equity pricing equation. Price equals earnings per share multiplied by the price to earnings multiple. As first quarter data shows, earnings per share, actual profits are holding steady. Despite market turbulence, the pressure is concentrated on the right side of the equation. Higher Treasury yields increase the discount rate, the metric investors use to calculate the current value of future cash flows. A higher discount rate mathematically compresses the PE multiple. Investors are simply paying less for the same dollar of future earnings, which drags the overall stock price lower. This dynamic reflects a transition toward tighter overall financial conditions and greater macroeconomic uncertainty. The market is not predicting mass corporate bankruptcies. It is enforcing a higher cost of capital across the board. This explains why the Nasdaq experienced the most pronounced weakness. The index is weighted toward long-duration growth assets, where cash flows are expected to be generated years into the future. Higher real yields act like gravity on those distant cash flows, disproportionately compressing valuation multiples across the technology sector. To see where the actual damage is located, we can map the sector using valuation compression on the x-axis and earnings momentum on the y-axis. Hardware companies remain resilient. AI infrastructure, semiconductors, and memory businesses plot into the top left, showing strong earnings momentum that has shielded them from the worst of the repricing. By contrast, software and SaaS companies have undergone severe repricing, falling into the bottom right quadrant as their multiple shrink. Software valuations face a specific challenge beyond the yield environment. Investors are reassessing the durability of SaaS business models in an economy increasingly disrupted by artificial intelligence. This indicates that the tech sell-off is not a blind panic, but a targeted reevaluation of which business models can survive both higher yields and AI disruption. Moving to domestic small caps, the Russell 2000 closed March at 2,414. This index serves as a barometer for domestic growth and sensitivity to funding costs. Small cap companies are structurally more sensitive to higher financing costs and tighter liquidity than large cap firms that maintain deep cash reserves. While the Russell has trended lower, short interest in small cap exposure has risen materially. Institutional investors are placing significant bets that these companies have further to fall. This extreme short positioning creates the exact architectural setup for a sharp recovery if the downward momentum breaks. For that recovery to trigger, the broader macroeconomic environment must show signs of stabilization. If downside expectations prove excessive, short sellers will be forced to buy back shares rapidly to cover their positions, fueling a sudden rally. By aggressively betting against the most vulnerable sector, the market has manufactured the exact structural fuel needed for a sharp rebound. Evaluating the timing of this correction requires looking at institutional positioning and market psychology. Markets often bottom when conditions become washed out, a state where most sellers have already exited their positions. Fear indicators are currently at extreme levels, and bearish sentiment among traders is highly elevated. Furthermore, the relative strength index shows that the speed of the sell-off has pushed the market into deep oversold territory, extreme fear and oversold. Technicals do not guarantee an immediate market bottom. They do, however, indicate that a substantial amount of risk has already been discounted into current stock prices. Selling into historic extremes of fear and oversold conditions is statistically a bet against the mechanics of market capitulation. Near-term risks could still delay market stabilization, particularly if global oil prices show sustained strength. Ongoing policy risks also remain, such as further upward pressure on bond yields or a Federal Reserve that stays restrictive longer than expected. Despite these headwinds, the base case is that this correction is moving into its later stages. The core evidence is here. Valuations have reset, positioning is defensive, and earnings expectations have held up better than price performance implies. While macro risks create a temporary ceiling, resilient corporate earnings historically overcome multiple compression to stabilize the market over the medium term. This distinction defines the difference between a prolonged bear market and a mid-cycle correction. This constructive framework remains the base case provided the current macro shock does not develop into a broader recessionary event. Unless a recession materializes, the market is likely moving toward the end of its most aggressive multiple compression phase as corporate profits have remained stable. For investors who distinguish between price volatility and fundamental deterioration, this repricing has created the conditions for a constructive medium-term outlook.